MarineMax just swung from a $52.1 million quarterly loss to a $15.4 million profit. Operating income moved $78.8 million in 12 months, and revenue over that same period went down 7%. A swing that large on falling sales is almost always an accounting event. So the question is, how much of this one was real? Here is the ARC, reported operating income by quarter. $39 million, then $22.7 million, then a loss of $41.5 million, then $4.9 million, $10.8 million, and $37.2 million. 5 quarters of pain, and only the last bar turned. That negative bar is a write-down. The prior year quarter carried a $69.1 million non-cash goodwill impairment. And it was not the dealerships. The charge hit the product manufacturing segment, cruisers, yachts, and intrepid powerboats. And it wrote that unit's goodwill all the way to zero. Put the segments side by side and the story separates. Retail operations earned $37.2 million this quarter, up from $28.1 million. That is up 32%. Product manufacturing lost $600,000 against $72.4 million a year ago. Strip the write-down out of that prior year total, and the real comparison is $37.2 million against $27.5 million, up 35%, not a $78 million reversal. So $9.7 million of that swing is real, and it came from somewhere genuinely interesting. Revenue fell 7% to $611.3 million. Comparable store sales fell 7.1%, but gross profit rose 9.3%, and gross margin expanded 5.3 points to 35.7%. MarineMax sold fewer boats and made more money doing it. The answer is mix. New boats fell from 63.6% of revenue to 59.3%. Storage and charter rentals rose from 6.4% to 8%. Brokerage went from 4.5 to 5.5. Every line that carries a better margin got bigger. The marina and storage business alone grew 12.5%, while boat sales shrank. For a boat dealer, carrying cost is the whole game. Inventory is financed on a floor plan facility priced 3.25% above the benchmark rate, so every unsold hull is a meter running. Inventory fell 13% to $788.6 million. Floor plan borrowings fell 17.3% to $608.3 million. Interest expense fell 15.5% to $14.3 million. They destocked faster than sales fell, and the destocking turned into cash. Operating cash flow for the 9 months was $157.6 million, against $11.4 million a year earlier, on 9-month net income of just $4.8 million. Management used it to retire $105.6 million of floor plan debt and $28.8 million of long-term debt. Now the part that cuts the other way. 1 quarter is not a trend. Over 9 months, add the write-down back, and prior year operating income becomes $89.2 million, against $53 million this year. And the prior year also carried a $25.7 million gain from revaluing contingent consideration. Strip out both distortions, and the clean comparison is $52.6 million, against $63.5 million. Still down about 17%. The recovery is exactly 1 quarter old. So what is it worth? The stock closed at $36.25 on July 27th, a market value of about $801 million. Book value is $43.12 a share, so it trades below book. Under our stated assumptions, the base case lands at $26 to $31 a share, and the bull case at $45 to $49. Today's price sits above the base case, and there is a reason that is not in the filing. Reuters reported on July 24th that Blackstone, Donerail, and Centerbridge are among the final bidders. The 10Q says nothing about any of it. This entire analysis was built using robo-systems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai. Link in the description.